gave up managing billions to become a better investor. Episode 26. Finally, people are worrying about 60-40 portfolios. Hello. Yes, it's been another busy week in financial markets. Unsurprisingly, corporate earnings season has been utterly critical, exciting, interesting. We'll talk more about some interesting insights over the last week there in a couple of minutes' time. We've seen another central bank raise interest rates, this time the Bank of England. Huge surprise, but I kind of still feel as if they're on the wrong track, as I believe when you push expectations or where the likelihood is inflation is going to be in 6 months' time, 9 months' time. If I was the Bank of England, I wouldn't have been raising interest rates. But there you go. We'll find out, as I've talked about before in previous podcasts, what the reality is in 6 months' time, turn of the year, etc., etc. It's been kind of interesting to see a little bit of volatility in markets, though. We ended July with the VIX index, or the volatility indicator, at a multi-year low. And then suddenly, as per usual, when everyone is greedy, best to be a little bit fearful, and there was a little bit of volatility in markets. But again, a kind of a normal thing for August. Thinner markets, people going on holiday, or at least lots of lead fund managers or brokers or related going on holiday. Therefore, the continued flow of information, a bit of uncertainty out there, a bit of unknown elements, and then boom, what can be a small issue can suddenly become a big one. And that kind of brings us, interestingly, of course, to US government bond yields and the update that another indicator is going to go down from a AAA rating down to below that. Not the first time we've seen this. We saw the first one of these shifts by government bond thinkers a number of years ago. But it's kind of interesting, isn't it? It's interesting to me how it's concerned people. And inevitably what you saw from that was higher bond yields, and hence derived from that, well, oh my goodness, certain areas of the financial markets are therefore overvalued, etc., etc. And as I say, you put that together with a little bit of natural illiquidity, August thoughts and related, and stock markets have ended the week lower, and bond yields higher, of course, higher yields, lower prices, and the like. And all of that, when you put it all together, has made people think again about, oh my goodness, what should we be doing about our allocations? Before we answer that question, let's think quickly about earnings season updates. And I thought I'd look on 3 different sectors when I look at all the different companies I looked at over the last week. 3 sectors strike me as particularly insightful, and 3 what I would regard as important sectors, certainly influential for any people thinking about asset allocation decisions, and ultimately the aforementioned need to talk about, once again, the 60-40 portfolio consensus and why, in my opinion, that's a bit crazy. So, first sector is technology. No surprises there that the Apple numbers out late doors Thursday in US time, obviously impactful upon livestock markets on Friday, a couple of days ago as I speak. Now that kind of, I wouldn't say concerned a few people, but there was a correct appreciation that Apple shares were a little bit firm versus the reality of what their performances, what their numbers actually look like. There's nothing fundamentally wrong with Apple. I'm not an Apple user myself, but plenty of people are, and I can see that even beyond iPhones and related, Apple has plenty of scope to continue building that business, having lots of people as regular customers, users, and related. And as always, I think they've learned from some of the errors from Nokia 20 odd years ago. One of the benefits of being sort of a later day player rather than sort of the initial number one. I think Apple have learned how to think a little bit better about the need to be a next generation thinker. And there is no doubt that Apple are pitched very much at the top end of the middle range of markets to the top end of markets. No doubt about that at all. Probably actually sensible from a medium-term perspective for them. They're moving further away from being the world's number one, perhaps never was number one mobile phone supplier. But my guess is, outside of people's quite high level of obsession in the UK or US, Japanese, some European markets, etc. When you look across the broader, wider world, unsurprisingly, there are broader interests out there, broader providers, broader interests in different phone networks and the like, which is absolutely fine and totally understood. Anyway, as an analyst, of course, I look back at the Apple share price, look at its fair value. And to my mind, it's below, even after Friday's falls in the Apple share price, it's below the current levels, which is fine. Is it disastrously below? No. Is Apple going to be Nokia Mark II? Probably not. I think the services side is too exciting and too interesting on a multi-year basis for that not to happen, let alone the experience that they've gained from Nokia's mistakes. But is it a must buy? Oh my goodness. World's largest market cap company is a must need for a pension fund portfolio. I would actually say no. And we're once again to this notion that you've got to be active as an investor. The thoughts that it's right to be a cheap passive fund is more than enough. And of course, a cheap passive fund, by definition, is going to have a good exposure to not just US shares, not just technology shares, but Apple per se and a few other names. And I think you've got to be more flexible than that. That's my personal perception in any case. We shall see. Elsewhere in the tech space, Amazon, another mega cap company. Again, actually not one that I own, although one that I periodically use in various guises. Fine set of numbers, well-received set of numbers. Again, Amazon is so much more than the Amazon that perhaps many of us use on a, not necessarily a day-to-day basis, but a regular basis. And the cloud perspective is really the key, still is the key for the Amazon business. And obviously an important part of Microsoft's business. We talked about that in a previous podcast, and Alphabet too. So on that perspective, Amazon, after a dodgy 2022, is like so many technology companies having a better 2023. Is it fundamentally a company I think is cheap? Not really. I actually think, again, the future's been anticipated quite firmly now, even more firmly over recent price movements, certainly after the last set of numbers earlier this week. Is it again a name that you have to own? Oh my goodness, it's an essential part of my living, day-to-day life, therefore I've got to own it as a share? The answer is actually probably not. Certainly being a day-to-day or a regular user of Amazon is always helpful. It's always helpful to have that when you're looking at a company. Is it though a need to be an owner of a share? Actually, no, it isn't. You may be buying it for a certain reason. You may actually be buying an area which is, in Amazon's case, not as profitable as its core, or at least core profitable business, which is, of course, cloud, which, of course, you may or may not use, or your corporate links may or may not use. But my feeling would be no essential need to own Amazon here. I'm happy to be on the sidelines, but keep an eye on it because it's a big company and an interesting company to follow. It's going to tell you something about markets and the tech sector per se. More interesting, actually, is a bit of a name which has been around for a while. Actually, many of us are users in some way or form. PayPal. PayPal's interesting, not just because the shares were down, I think it was about 12% after its number publication earlier this week. So a pretty lousy performance by the shares. It's actually been, like many technology companies, a good performer over recent months. I actually bought some shares myself for the first time in a long, long time earlier this year when the shares fell below $60. And I was thinking my target actually was $80. That was my fair price. And interesting, when I rerun the numbers today and think about what they said on their conference call a couple of days ago and related, I'm still running at a pretty similar level, but the shares have fallen back circa 15%. They were north of $70. Now they're, under $65. And I actually took the opportunity to buy a few more PayPal shares before the end of last week. And the reason why is because when I listened to the conference call, it was actually, this is interesting. It's not impossible. There are angles here that I still like and I think are underappreciated by markets. Now, well aware that PayPal shares are, there are alternative competitors to them. Apple actually, in a weird way, would be one of them. Amazon, slightly less so, but there are other companies that do compete against even core PayPal offerings, let alone newer style ones or areas they're trying to develop or improve. What I would say, though, is that I was pleased with, and this is where I guess the world of technology becomes particularly interesting. When you start talking about free cash flow, when you start talking about what is the valuation of this business in terms of a conventional measure, not looking at extreme future, not saying, oh, in the end of the 2020s, this is going to be absolutely essential. We're all going to be having it, because we all know that trying to predict 5 years away is tough, let alone even more than that. Or it's not a sort of an Apple or an Amazon where well-known, well-used, firmly priced, maybe for some reasons, but I would still say too much has been kind of factored in or anticipated. PayPal feels the other way around, where I can still see scope, so can the company, still see scope for improvement and forward progress. You're also getting paid to wait, in the sense that not just buybacks or free cash flow, but also the notion that actually the company is still growing. And for me, that's an interesting combination, where you've got a lowish valuation, in my opinion at least, not low against broader parts of the market maybe, but low against the technology space. I'll even say low against a company that's still growing, and certainly in terms of operating profit growth, at a high single-digit level, still generating attractive cash flow, still doing things which are kind of positive in that backdrop, buying back shares and related developing the business as well. I still think it's an $80 share. So anyway, I bought a few more PayPal shares after their numbers a few days ago, last week if you like, or still this week, depending on your views, whether a Sunday is the end or the start of a new week, etc. Anyway, still like PayPal, bought more shares. We'll see how that one progresses over the next 3, 6, 9 months or so. Consumer stocks, again, always a critical area. We've talked about many times over the last few weeks about consumer names and related. Couple of quick updates. Fascinating. Again, we come back to the world of price mix. Price mix is so insightful, particularly in these times of volatility, uncertainty, who has the pricing power and who doesn't. Good to see, for example, Kraft Heinz shares. I know there's been a lot of, we downgraded from our use of Heinz baked beans because the ones in the supermarket were cheaper, etc., etc. Well, I'm sure some people have done that, but quality, good product, it goes a long way. And you saw that in the Kraft Heinz numbers, which are perfectly fine. I reckon a share that is still a bit undervalued and paying you a dividend yield of a little bit shy of 5%. I don't own the share. I think there are other ones to buy in the consumer space. You can't own everything out there. But if you did own Kraft Heinz shares, that's absolutely fine. I think you could do a lot worse from a total return pension fund perspective. So ticking the box for them. I'd say the same about Diageo as well. Of course, a completely different share in the sense that you're now moving towards the slightly more sort of quality spirits and various other parts of the alcohol and beverage areas and regions. But Diageo is a company which actually I do own, and I bought the share for the first time in a long time, earlier this year. And I felt that when I saw the share price in that sort of, when I bought my initial shares at the sort of £34 and change level, and I've actually, again, a bit like my observations about PayPal, with Heineken, after their numbers were published earlier in the week that's just finishing, I decided to buy a few more shares after that as well. The shares backed off a little bit. Yes, there's a bit of general market volatility as well, but I thought the update was solid in the sense that the new CEO, the previous CEO sadly passed away, and the new CEO, I thought, gave a good presentation, good insights as to the strategic importance of a Diageo, the relevance of a Diageo in many countries around the world, increasingly, inevitably, in the emerging market part of the world over time. That is something which, frankly, all consumer companies are talking more and more about, quite correctly. But Diageo strikes me as a business which is a little undervalued just from a pure valuation sort of perspective, but actually, particularly when I look at other quality consumer names, and I guess this is pushing me more towards luxury goods and related, and let's face it, Diageo, I guess you don't need to be a luxury consumer only to regard Guinness as a must-have, but there are cheaper options out there. When you look at the spirits business, fascinating to see the sort of the super premium or premium angles that Diageo are very much focused on, is becoming increasingly a key and even more important part of their business. And my guess is a bit like a few other consumer companies. I think I mentioned this about sort of the Unilevers and related of this space a few weeks ago. Inevitably, you're seeing a few sales of products which are towards the lower end. And that's absolutely fine. It's not that actually they're worth nothing, because they're not. Often there are reasonable sellers. There's possibly, though, little future growth to come. Maybe because they're a little bit more developed market focused, maybe, or maybe it's because they're a little bit more middle of the market or lower middle end of the market focused. And maybe that can be managed better by another entity, someone perhaps who is happy to buy that sort of business or sub-business at a certain price and run it for the next 10 years or something. It doesn't fit into maybe a Unilever's or a Nestle. I've seen exactly the same there as well. And my guess is actually I'll see the same at Diageo. I think they'll continue to evolve the business, but evolve it upwards. That would be my perception. Anyway, I still like Diageo shares. My feeling is that combination of, a bit like Kraft Heinz actually, good dividend yield, solid dividend yield. I think underlying medium-term good free cash flow, not ridiculous valuation. You put it all together, Diageo shares should be north of £40, in my opinion, without working too hard. Therefore, from a pension fund perspective, despite the fact that actually personally I don't consume alcohol, so I'm afraid Diageo are not going to get many earnings or related from me, but nevertheless, I would regard it as an attractive business, one I still like. Heineken, so we now kind of gone into a slightly different, but not wholly different part of beverage and related alcoholic areas. Heineken I've always regarded Heineken as a very well-run company. Good set of products. Don't need to tell you what some of them are by definition, by the company's name. Good set of products, inevitably a more global focus progressively over time, which makes sense. Interesting, their shares reacted negatively to the numbers published a little bit under a week ago, but earlier this week. And I found that interesting because I think actually I almost wondered whether some of the price mix angles weren't quite as attractive or quite as well performing as perhaps I'd seen elsewhere in the consumer sector. And that is something you've always got to watch. Consumer stocks, it's a competitive world. It's not a boring world. It's a changing world. Strong companies do have regularly attractive price mix indicators or free cash flow generation, but it's not guaranteed. Things can change and evolve. And I almost felt as if maybe Heineken shares, which I don't own and I haven't owned for a while, but they'd kind of gone from, my perception at least was that they'd gone from cheap, which was true a period of time ago, to kind of being firmly valued or quite firmly valued as it went into this earnings season. Certainly my spreadsheet monitoring attractive companies or high quality companies that I follow, it was telling me that Heineken was feeling a little bit overvalued. And actually we've now seen a bit of a fallback of the share price, falling closer, not quite there, back there to the levels where I regard it as a buy again, but certainly at a more sensible valuation today. If you own Heineken shares, I wouldn't panic, even though you're probably thinking, oh my goodness, what's going on? Something's changing. Maybe consumers are moving away from Heineken product and the like. I don't think so. I just think that, again, as with many consumer names, you've got to think through on these stocks. Think, is there a relevance here for the medium term or not? Will they have medium term pricing power? Are they in an attractive area or not? Do they have a good medium term market share or not? Heineken, I think, there still ticks in the boxes on all of those fronts. I just think that the shares have moved a bit too quick, and we're back to sort of, if you like, the interesting levels of volatility for a variety of macro and a bit of sort of lack of market awareness and whatever in August. Kind of interesting to see Heineken shares fall back. Not wholly surprised though. At a lower share price, probably certainly below a €90 level, it's starting to look a bit more, interesting to look for that bad day to find an opportunity, but not yet. If you had to put money to work in the names I've mentioned, probably your Kraft Heinz's or your Diageo's, the latter of which I did add to my holding during the last week, would probably be a bit more interesting. Before I talk about things for too long on the equity front, one final mention would be the facilitation area. I know this sort of strangely named space that I regard as important because a company is assisting, if you like, a bunch of other sectors or subsectors and related. Three names, again, why is it always in three, that I wanted to briefly talk about, which I thought were kind of interesting updates this week. One was Rolls-Royce, which actually in hindsight, I sold my shares there too early. I bought shares well and sensibly and added to shares well and sensibly in Rolls-Royce at various points over the last 9-12 months. And it's worked out really well this year. If you look at Rolls-Royce shares, obviously well known for their aircraft engine side, but also exposures to a few other areas with the Navy, be it on the nuclear side, and some other options as well. Interesting company, not anything to do with Rolls-Royce cars related, which is owned by BMW nowadays, just to remind you of that front. Used to be all together, but that was a different way and certainly a different decade. But nevertheless, Rolls-Royce shares perform very well. They continue to perform well. Actually, they moved back above £2 a share when I last looked. I actually sold the shares a bit too early, but that's the way it goes. However, again, a company going from fear about its balance sheet, oh my goodness, COVID-19 lockdowns were going to really hurt and sort of an engine business to the aircrafts and airline sector, which is all absolutely true, of course. But when a change happens, then other changes occur. And the fact that Rolls-Royce did raise money, actually quite in now relatively attractive level 18 months ago or so. When you think about that was a sensible move, and ultimately Rolls-Royce shares, I would say, now are fairly firmly valued. I guess I should have concluded that at a more sensible point in the last week rather than a couple of months ago. But such is life. Still, an indication that when you're thinking about companies, you've always got to think about, okay, if there is a short-term problem, can it be fixed? Is fundamentally the company still a good one, still has an attractive position, an attractive rationale? Could there be a recovery for this name or not? Particularly, and forget the notion that you only see this in small caps. You don't. The world's largest companies, well-known FTSE 100, S&P 500 names, plenty of them have mass volatility, often way too much, just maybe because formal owners and institutional owners and the like have sold their shares and panicked out of them because they've gone from a big holding to oh my goodness, why on earth are we holding that one? Some of those companies, of course, disappear. Others miraculously come back and actually perform much better than people would have thought a year or two ago. So Rolls-Royce, that was good, but I think we're there now in terms of what I would regard as a sensible valuation. It's not that I talked about the sort of broader defence area in a previous podcast a couple of weeks ago, and it's an interesting space always to look at, and sadly always a relevant space from a macro geopolitical perspective. Similarly, I guess from that perspective, we should think about A.P. Moller-Maersk, which is, of course, if we're into shipping and trade and relevance there, this is still a wholly relevant company. And Danish named global operator, again, an interesting update in their quarterly numbers in the last week. Actually came out towards the end of the week just finishing. And I wasn't surprised to see the numbers slightly negatively taken. It's actually not because the company is in some kind of, oh my goodness, problem area. The numbers were perfectly fine. But I always think with A.P. Moller-Maersk that a bit like anything, shipping, a bit like areas such as mining, for example, you've got to be optimistic when the market is pessimistic and vice versa. Be greedy when others are fearful and all of that. And that is particularly true in areas such as shipping, which is a bit like mining and related. Big capex zones, global oriented, global players, global suppliers. Therefore, when you have that kind of, oh my goodness, we've spent money on new products, but suddenly the macro backdrop has become mixed, messy, competitive, whatever it might be, you've got a bad combination. And it's interesting. I would say, despite people's fears about, oh my goodness, the trade backdrop is going to get worse, we're going to see 1930s times 2 issues during the 2030s, etc., etc. I'm not sure about that. I actually think that shipping, trade flows and related are actually becoming more, not less important. Perhaps more important in different ways, different manners. It's not that you can deliver everything via the computer, nor is it that you can produce everything locally. I think there's a reality where, despite people's efforts to do more on the computer and perhaps try to boost local production, there are other things which are naturally occurring in a still evolving world, particularly involving the developing markets. So my guess is the relevance of a shipping and distribution and related company like A.P. Moller-Maersk is still high. But you've got to find the right time to invest. And obviously the excitement of the share price with matters around, oh my goodness, what is happening re-COVID and the impacts from there, which obviously can be both bad and good for things like the shipping area. You recall the shipping levels were at very high points. Yes, better for an A.P. Moller-Maersk than it is for companies relying on shipping the products and etc. You now shift around it a little bit around to the other way, which is shipping prices are much, much lower, which is obviously better for the average company, but less for A.P. Moller-Maersk per se. I kind of think the sort of the sensible price, the price I've had for a little while, is waiting for when A.P. Moller-Maersk shares get back to the Danish crown 10,000 level. I think when we get there, that is what I would regard as attractive for me. We're not there at the moment, actually. Share, I'd say, is still a little bit firm. It's correctly come down already a good amount from those, if you like, high shipping price highs. I would still wait with this one. But an interesting company, very high quality in the sense that I would regard it as the likely global number one, if I had to sort of look at the shipping sector in 10 years' time, which, a bit like aforementioned chat about your Diageos, your Heinekens, I guess to some extent people would think about the Apples and related as well. But my thoughts already on that one. Good companies, sustainable market positions and profiles, they're the ones you've got to be thinking about sensibly as your core kind of pension fund investment holdings. But it doesn't mean they're necessarily cheap. And ironically, as times you'll get them to be deeply cheap and highly exciting, just as you've got other points where they'll be extremely expensive. It is an active world after all, and you've got to be doing your research and understanding. And it's not that everything moves in a kind of a linear fashion, everything up or everything down or something like that. Final point in what I've called the facilitation area, and actually the share that, a bit like, as I've already mentioned, bought some PayPal shares this week, bought some Diageo shares. The third share that I bought some of was Mondi, which those of you in the paper and packaging area, I'm not going to call it a specialist space. It's probably of less attraction to many investment watchers. Honestly, I thought the Mondi numbers were absolutely fine. Yes, we can have an interesting discussion about the cost of paper, the impact on that, on pricing, on what the average industrial user is thinking about the need for paper and packaging products and related. But relevance of paper versus plastic is, I would say, only going one way, let alone the fact that whilst we've moved away from the peak use of, bringing us back again to talk about Amazon really, about distribution to your home of products that you've ordered online, etc., whilst clearly it's a different backdrop than the sort of the deep COVID period, nevertheless, when I look medium term, the relevance for the fast-moving consumer goods sector, the Amazons of this world and related of packaging product, recyclable packaging product is still very high. There aren't many, you'd be surprised actually, there are not as many players in this space as you think, particularly what I would regard as quality, next generation players, and Mondi is one of them. So I actually thought, looking through the Mondi numbers, listening to the conference call on Related, I thought to myself, I'm picking up, it's a bit like with Kraft Heinz, I'm picking up that circa 5% dividend yield, which is attractive. I'm also seeing the likelihood, I would say, of medium-term growth, got high market share in certain select areas, a nice global orientation. Yes, some tricky exposure to Russia, which they're having a couple of small issues with, unsurprisingly, but good attractive exposure to markets in the Americas, Europe, parts of the developing market world too, which I think is nice, and I can see further growth there. And a valuation which I think is cheap when you put it all together. So I think underappraised, undervalued, and consequently a too cheap stock. I actually bought some Mondi shares for the first time for that name for a number of years earlier this year at around a not dissimilar level from the current share price, that sort of either side of £13. I added to the position as a consequence of this week's thoughts, just because, a bit like PayPal, I thought the immediate reaction by the market was a bit rude, really, pulling back of the shares and Related. So there you go. As always, with markets, you've got to be active. Which brings us back actually to what I even said this podcast was all about, but I've spent too many minutes talking about shares and interesting numbers in earnings season, a little bit of Bank of England chat and Related, is the 60-40 portfolio, which I saw an interesting report online earlier this week, which said that people are worrying about it now. You know, the 60% equity, 40% bond, that sort of medium-term average, you know, a number of years to go in their pension fund investor should be doing, because here's the good news. You've got a bit more equities where there's a bit more growth, but you've got enough bonds to protect you when there's market volatility. But as people saw last year, you can get times when equities were down and bonds are down. And whilst this year you've got equities up and bonds kind of not up. In most cases, bond yields are higher, prices are lower in many markets. And despite the fact that bond yields are paying you a higher yield, from a total return perspective, not attractive still. And it's funny, we then bring it back full circle to what we talked about too many minutes ago now, probably, about US credit ratings and thoughts of US bond watchers and the Related moving away from AAA ratings and the like. And we come back to the notion, what happens? How should you be thinking about bond yields and the profile of the bond market when you have aging economies, high debt levels and Related? It's not that the average developed market bond, even corporate bond, is going to go bust. There'll always be some corporate bonds that go bust, but not probably as many as people think. Certainly not when you're looking at the more larger mid-cap world. By contrast, if we look at government bonds in the developed market world, I reckon none of them are going to default. I know there's occasional fear about this and that, but I don't think it's going to happen. Or what will happen is the practicality is when there is higher uncertainty, matters that we've seen in various parts of Southern Europe, for example, at various points over the last 10 or 20 years, you see higher bond yields. Frankly, you go back far enough to the late 1970s, early 1980s, you saw that those mega inflation issues, concerns, where on earth was growth going, higher bond yields and Related, which is a perfectly rational reaction to sort of greater uncertainty or greater matters which would concern the average bond investor, even government bond investor. So ironically, even though I know I talked earlier about, oh my goodness, inflation is coming down, central banks should not be raising interest rates, we're back though to that middle ground, which is people have got to get into their investing heads for the rest of the 2020s and into the 2030s for the most boring mainstream government bond in the developed market world, is that reality is when you have more debt, when you have aging populations, when you have the reality that if you're getting that 2% inflation rate regularly, it's probably because there's no growth. More likely is that you'll have a 2 to 4% inflation level and a bit of growth. And when you have that backdrop, a right and correct bond yield, let's say a 10-year bond yield in the States, in the UK or whatever, is, let's call it, either side of 4%. And that's not widely different from prevailing bond yield levels. And even though you're picking up that yield, actually, as we've already talked about in this podcast, you don't have to work too hard to find some actually quite interesting equity companies with more attractive bond yields, more attractive yields than that. And of course, they have overt growth scope, or at least the potential for growth on a multi-year, next decade or so basis, which of course the average bond doesn't have. Yes, you'll get your money back, your initial investment back, and you'll get some yield on top of that. But from a total return perspective, back to this notion again, as I've talked about my personal pension fund portfolio already, my allocation to bonds is precisely zero at this moment in time. And as you know, my neutral view is that people should, their correct bond position for their pension fund should be their age minus 50, i.e., if you were a 50-year-old, you should have zero in bonds. If you're a 70-year-old, you should have 20% of your portfolio in bonds, etc. Except if you're below 50, you should have nothing. Mainly because if you're at that lower age level, you have plenty of time and scope to find opportunities in equities. But I also do a corollary here, a sort of an additional thought. You also know that my view is it's important for me to have a 10% holding in gold and gold-related investments. I always want to have some hedge alternative there. That isn't money in the bank per se. I talked about this before. Nice to have a bit of money in the bank to pay your bills and the like. But if you're talking about your pension funds and saying, we must have X% in cash, then unless you're just keeping some dry cash, some available cash to invest in something next week or whatever, or next month, what's the point? So similarly, I think if you want a true alternative, that is still gold. Before making this podcast way too long, I'll get into another rant about gold next time. But we've got a big gold number next week in next week's earnings season, which will probably have its own special podcast just because of my great enthusiasm for the space. So more on that then. I guess what I'm trying to say is that investors need to think about a broader range of alternatives. And 60/40 portfolios, I'm going to call them passé. Now, I know that is slightly arrogant and probably thinking, this has worked. Who can't say it's not going to work over the next few years? Fine. Maybe it in quotes works. Maybe it is perfectly remunerative for the average pension fund investor. Maybe. And let's face it, as you know, I have a lot of problems with corporate pension funds because they often have way more than 40% in bonds, because actuaries say to keep it safe and sensible, we've got to have 90% in bonds. Well, good luck with that. I mean, yes, I guess it minimises your Bob Maxwell angle, and maybe it means that you definitely can afford to keep on paying people their pension fund payments over longer life periods and related. But I wonder what it means in terms of the returns from funds. But anyway, talked about that before. I guess I will talk about it again at some point. But big observation, I guess, of this podcast would be, again, corporate earnings season is interesting. Not always good news, but enough's out there. Enough workable backdrop is out there to think for the average investor, equity markets remain the core of your area of excitement. Now, there is going to be volatility at some point. We've seen a little bit of it this week. Guess we could see more of it in the upcoming week. But anybody who is an investor surely should be thinking more about how's August going to perform. Fine if you're a day trader or something, that's your bag. That's not something I'm any good at or have any particular thoughts on. But for medium-term investors, they should not be concerned. And actually, I would say the 60/40 portfolio, that would concern me. In fact, and I'll conclude here, you'd be pleased to know, according to my theory that the appropriate bond investment is your own age minus 50, to be a 60/40 portfolio allocator, to have that sort of thing in your pension fund, you've got to be 90 years old. So there you go. Chris Bailey says that you've got to be a 90-year-old investor to have a 60-40 portfolio allocation, which I think is a kind of interesting conclusion, really. But that's what I think. That's how I see the world. I think there are better allocations to be having, unless you're 90. So if you're 90, thumbs up and go for it. If you're under 90, then maybe have another think. On that basis, I think I better move on and speak to you again soon about some other investment and related issues. So thanks very much for listening, and bye-bye.